Most investors cite increased diversification as their main justification for buying shares of foreign corporations. As international markets occasionally behave differently than U.S. markets, spreading your investment risk across different countries may help reduce the volatility of your portfolio and possibly limit your losses should a particular market decline. Nevertheless, they frequently generate enormous profits. So what should you do if you want to learn how to invest outside of the US and the UK? Make sure to watch the entire video. However, if you're new here, be sure to give this video a thumbs up and subscribe before we begin the video. 1. American Depository Receipts, ADRs. The American Depository Receipts, ADRs, is a negotiable certificate issued by a U.S. depository bank that represents a specific number of shares, typically one share, of the stock of a foreign company. Like any domestic share, the ADR is traded on American stock exchanges. American investors now have the opportunity to purchase stock in foreign companies that they otherwise couldn't. This is made possible by ADRs. Since ADRs enable them to attract American capital and investors without the hassle and expense of going public on American stock exchanges, foreign businesses also benefit from this arrangement. Even though they are traded on American markets, ADRs still offer the advantages of diversity, and their prices frequently behave like the foreign stocks they represent. The US dollar serves as the basic unit of account for American depository receipts. The underlying securities holding company is typically a U.S. financial institution with a branch abroad. The hassle of dealing in foreign currencies or stressing over currency exchange rates is not an issue for ADR holders. Through American settlement channels, these securities are valued, traded, and cleared in dollars. However, in order to offer ADRs, a U.S. bank must first purchase shares on a foreign exchange. An ADR is issued for domestic trade, and the stock is kept by the bank as inventory. Although they can also be bought off exchange, ADRs are listed on either the New York Stock Exchange or the NASDAQ OTC. 2. U.S.-traded international stocks. You can diversify your portfolios, reduce risk, and take advantage of economic growth in economies other than your own by owning international equities or the stock of companies based outside of your home country. You likely already understand the importance of diversification in your investment portfolio. By spreading your money among tens or hundreds of businesses, you decrease the likelihood that you will lose money overall even if one investment is a failure. You probably already know how important diversification is for your financial portfolio. If you spread your money out over dozens, even hundreds of businesses, your chances of losing money overall in the event that one investment fails are reduced. Investing abroad may also help you increase your profits by exposing your money to nations with faster growth rates. You might run into advantageous conditions like progressive government leadership, tax breaks, or even access to natural resources and regulations that allow an industry to grow faster than a domestic counterpart might. Because they have met the listing requirements of the New York Stock Exchange, NYSE, or NASDAQ, some foreign stocks are traded on U.S. exchanges. 3. Mutual funds. An open-end fund is a business that collects money from numerous individuals and invests it in securities such as stocks, bonds, and short-term debt. Any or all of the mutual fund's holdings are referred to as its portfolio. Investors purchase open-end fund shares. Each share represents a shareholder's ownership interest in the fund and, consequently, the income it generates. Because the value of the securities held by a fund may decline, it is crucial to remember that all investments carry some level of risk. Dividends or interest payments may change as market conditions change. The past performance of a fund is not as important as you might think because it cannot predict future returns. Past performance, on the other hand, will demonstrate how stable or erratic a fund has been over time. With fund volatility, an investment's risk will rise. The most crucial choice you must make is whether you want to outperform the market or try to copy it. I'm referring to choosing between active and passive mutual fund strategies. The choice is also relatively straightforward because one strategy typically costs more than the other without providing better results. Aiming to outperform the market, professionals who manage actively managed funds do market research and make purchases. While some fund managers might be able to do so in the short term, it has proven difficult to consistently outperform the market over the long term. 4. ETF. If you're looking for a cheap, tax-efficient way to access a variety of asset classes, investing in ETFs might be your best bet. Exchange-traded funds, or ETFs, are exactly what their name implies, funds that occasionally track a specific index and trade on exchanges. When you purchase an ETF, You get a collection of assets that you can buy and sell during trading hours, possibly lowering your risk and exposure and assisting with portfolio diversifications. Exchange-traded funds for emerging markets invest in securities from underdeveloped countries. These countries' societies are changing quickly, and their economies are struggling. A list of the countries deemed emerging markets is included in the Morgan Stanley Capital International Emerging Market Index, MSCI. Similar to foreign market ETFs, emerging market ETFs offer a wide selection of markets. 5. International investment. When a foreign investor, business, or government invests in a foreign company or project, it is referred to as a foreign direct investment, FDI. The phrase typically refers to a corporate choice to acquire a sizable stake in or the entire business of a foreign firm in order to expand operations into a new market. The expression is not frequently used to describe a stock purchase in a single foreign company. FDI is essential to global economic integration because it creates solid, enduring links between the economies of different countries. Businesses or governments seeking foreign direct investment typically consider target businesses or projects in open economies that have a trained workforce and above-average development. Potential for the investor, FDI. It's also common to recognize the value of minimal government regulation. FDI frequently entails more than just capital investments. The provision of management, technology, and tools may also be necessary. One of its primary characteristics is the development of effective control over the foreign company, or at the very least, significant influence over its decision-making. Examples of ways to make foreign direct investments include opening a subsidiary or associate company abroad, purchasing a majority stake in an existing foreign company, merging with another foreign company, or establishing a joint venture. 6. U.S. multinational corporations. A multinational corporation, MNC, also known as a transnational corporation, is any business that is registered and operating simultaneously in more than one country. A corporation typically has its headquarters in one country and operates fully or partially owned subsidiaries in other countries. The corporate headquarters is where the corporation's subsidiaries report to. Gaining market share, as well as vertical and horizontal economies of scale, cost savings resulting from expanding output and consolidating management, are advantages of forming a multinational corporation for a business. The technological know-how, skilled workforce, and tried-and-true business models of a company can typically be transferred from one country to another, despite the possibility that cultural differences will present unanticipated difficulties as businesses establish offices and manufacturing facilities around the world. It is common to criticize multinational corporations for acting as economic and frequently political tools of foreign hegemony. Being dependent on a small number of exports, often of basic goods, developing countries are especially vulnerable to economic exploitation. Monopolistic business practices, human rights abuses, and interference with more established economic growth strategies are some of the threats facing host nations. 7. Receipts from Global Depository, GDR. Another type of depository receipt is a Global Depository Receipt, GDR. Depository banks issue shares of foreign corporations on international markets, frequently in Europe, and make these shares available to investors both inside and outside of the United States. The majority of GDRs are, even though some are valued in euros or the British pound. These securities are typically traded, cleared, and settled, just like domestic equities. Among other exchanges, GDRs are traded on the Singapore, Frankfurt, Dubai, London, and Luxembourg stock exchanges. Before going on to trade publicly, Global Depository Receipts, GDR, are typically grouped with institutional investors in private offerings. A type of financial institution certificate known as an International Depository Receipt represents the stock of inventory in a global company. The stocks that control the GDR are still held by the depository bank or custodial organization. I hope this video has provided enough information about investment opportunities outside the US and UK. They are, in fact, both very profitable and risky at the same time. In other words, if there were no risks involved, it wouldn't be any fun. Basically, understanding the political and economic landscape of the nation you've chosen to invest in is absolutely essential. Always keep in mind that a good investor concentrates on their goals, costs, and potential returns. If you combine all of this with a moderate amount of risk tolerance, I believe you'll benefit most from investing outside of the US and the UK. I hope you all have a wonderful day, and I'll see you in the next video.